Yeah, so the classic Graham and Dodd approach in the past was that market would overprice a stock or underprice a stock, but the market would go ahead and correcting that overpricing or underpricing in a reasonable time frame, you know. And even if it took a little bit more time, and the individual stock, the value of the company would go up over the period of time, so you would make a good return by buying. So if you bought a stock 30% cheaper than what it was worth, and over a 3 year period of time, the stock became worth double what it was worth earlier, you would actually end up making from 70 to 200. So you would make three times your money by buying. This was the approach, and this is not the first time that stocks are getting overvalued. It's happened many times before in India. We have seen this in 1992 when we had absurd valuations, very high prices. In globally, we have seen that in 2000 in Nasdaq crisis. In 2008, we saw a bubble which sort of burst when Lehman crisis happened. What is different this time, if there is a difference, is that it's prolonged for a much longer period of time than people, the correction to fair value is not happened much. And I think there are two fundamental reasons for that. One is that cost of funds has continuously been lower than it has historically been, because of quantitative easing in the US and for whatever other reasons. So the alternate opportunities which people would have in debt markets and all are so low that people have become immune to risk, you know. So, and because people have experience of making money, they keep on plowing money into the market. So, as Graham said long back, at the market at most point of time is a voting machine, you know, and but it's eventually a weighing machine, you know. So, if more people decide to buy the stock will go up, even if it is well above average. Now, that's a problem for an individual investor. It's also a problem for a fund manager because if the market is going way above this thing, do you participate in that market and recognizing that this is not sustainable, but not knowing when the correction will happen? Now, if you're prudent and if you don't do that, and if you're a fund manager, as someone said, when you tell your clients that we are not participating and this market is not rational, they accept it and they do it. But continues for a period of time, they say, boss, you need to change your strategy and style. So it puts a lot of pressure on fund managers to either like you close down the business or you participate in what you're doing. And by participating, you're accelerating the process even further. For an individual investor, again, the choice is largely based on the philosophy of the individual investor. The individual investor is running a race against other investors and is very competitive. They would try to participate in this market, amending their strategies. But the investor is more rooted in their own philosophy of the market. There are fund managers who have done that, individuals who have done that. You can do that. You can decide to stay away from the market. It can be pretty painful, that you see stocks running away from you. But if you understand that these are not, so essentially, do you choose to become a trader and a speculator just because the market affords no opportunities for an investment, or do you say I'm an investor and if there are no investment opportunities, I want to invest? It's a choice you make. But the fact is that if you decide to participate, you have to understand that what you're doing now is not investing but speculating. You know, because if a stock is trading at 100 times earnings, there is a certain level of growth that the company has to have, which has to justify 100 times earnings. And many of the companies probably don't have that kind of ability to grow, which means sooner or later they're going to correct. They're either going to not give you any returns in the future, or they're going to correct to a level where they're going to give you losses in your portfolio and all that. But like I said, this is not a first time or an unusual situation in the market. But globally, it has become more protracted than it used to be before.